All right, so we are going to get started. So first and foremost, just wanted to I always like to just thank everybody for joining. Obviously, I know we're all busy, so I just appreciate you all taking time out of your day to spend hopefully about 30 minutes. It'll take somewhere between 20 to 30 minutes just to go through this stuff. And the hope is that you get something valuable from this, and maybe it opens up a door to I think have an opportunity to win one, two, three, four, who knows how many more loans in 2024. So with that, just real quick, my name is Ryan O'Kane. I am the co-founder of Arbor Financial Group. We've been around since 2010, so 14 years. I think it's really important that not only am I an owner, but I'm also an originator. So I still actively originate every day. So I'm talking to today not just as somebody who's running a mortgage bank and mortgage brokerage, but also somebody that is also actively originating on a daily basis and is in tune with the struggles that we all face in today's market. And so with that, we'll get started. So I think the first thing I just wanted to touch on here is really set the tone for what 2024 is. And I think it's really important to look back and look backwards at where we were. I think we all know, and we can kind of see the glory days there in those giant green bars of 2020, 21, and even on the tail end of 22 as kind of the post-COVID bubble kind of washed its way out. But I think what's really important about this slide one is to understand that what it means in terms of opportunities for us as originators. So when the market is full, when we have obviously when there's more loans out there, there's not as much pressure to win every single transaction, right? If there's 10 loans in your marketplace, you can win those 3, 4, 5 and actually still be doing okay. When that gets cut in half, and even call it cut down to 25% of that, there's only 3 or 4 loans, and you can't afford to lose half of those because you need the 2, 3, or 4 to feed your family and to kind of stay active and happy as an originator. So the bottom line is that there are fewer opportunities out there, which we all know. But I also think what's important too is if you look at how those gray and blue and orange bars play out, while they're not completely accurate in terms of subprime, near prime, and prime, I think what's really important is that, I would argue that non-QM is somewhat of the new subprime, right? I mean, we don't use the word subprime anymore. And I would say those of you that are really keyed into the non-QM market can see that that's kind of where the relabeled subprime is. And and that is percentage-wise a much larger piece of that green pie. So much more of what's out and available in the market today is going to be non-QM and near prime. And so that begs us to go out and understand that if we want to access more opportunities, we're going to have to get into different ponds and different pools to go find those. So as we transition from that concept, obviously we know there's fewer opportunities. I think it's important to then say, well, look, what were we really comfortable selling prior to 2024, right? So, we were really comfortable, when there's tons of loans in the market, it's all the easy stuff, right? We're doing conventional FHA, VA, and frankly, most of it was conventional because you remember, right? I mean, it was really difficult to get FHA and VA loans approved with how crazy the housing market was with everybody buying. There was adverse selection against those loans. There was a decent amount of jumbos in the market, and pretty much everybody was driving into that 30-year fixed market. One of the other things that I think is really important for originators to understand, and it's really one of the things that, I think is overlooked or maybe just not necessarily as transparent for most originators is understanding the actual margin, right? And understanding what loans are sold for by your company to the folks that are buying them, right? So when your company and you go out and you originate a loan and it's funded by your company and they turn around and they sell it to Fannie, Freddie, or Ginnie, right? How much money is there in the total pot, right? I think a lot of originators, they focus on their comp plan, and they know that there's some other money that has to be packed on top of that, but they're not necessarily 100% sure exactly what the total pie is when their company goes to the window and sells that loan. It's like, well, how much is actually in that? How much of that do I actually get? Well, when things are really good, okay, most of what people are selling are going, and they're going to the window and they're making 350 to 400 basis points on these easy transactions. And that these easy transactions are a lot of what fueled the scale and the size of the larger IMBs over the past, you could even say 13 years, is that there was just that many loans from post 2008, and as rates kept coming down, it was pretty easy to go find these loans as the market started to grow. And you're constantly running a business at this 350 to 400 basis point margin line because those products are there and that's what you can sell them for. All right. Well, that comes to a screeching halt in November of 2021. That's when we have that's when the inflation piece strikes up and rates start going through the roof. And what happens is now, rather than having these easy loans to sell, we're over here on the side and we're having to go dig into what do consumers need now in this post-COVID, this post-bubble market where we have these fewer opportunities. So you have they've run out of money. So you have rising credit card debt. They've got ultra low first rate mortgages, right? So they need HELOCs and fixed rate seconds to cash out to pay off certain debts because they don't want to touch their mortgage. They're looking at cash out, and again, most of them are going to cash out on that via that second mortgage and not touch the first, but some of them get desperate, so they need cash out. A lot of non-QM lending, right? So a lot of DSCR lending, a lot of bank statement lending, because that's where, again, there's investors are looking for opportunities in this market all the time. So that's essentially where non-QM comes in. First-time home buyer DPA grant program. So we know back in those previous markets, it was really difficult for first-time buyers to get in with low down payment, and because no sellers wanted to take it. But now that you have this really tight market, those first-time buyers have an opportunity to get in. You have DPA grant programs coming out with limited down payment, forgivable seconds. I mean, you name it. That's a market where people are focusing. Construction renovation, right? So that there's a housing shortage. So there's people are looking to, hey, I want to build my place because there's nothing there, or helping out builders that are trying to build inventory or build product into what is a really low inventory environment. Reverse lending, and also interest only. Point being is, like, these are all the things on the right-hand side that these are loans that are trading now that weren't really trading a whole bunch back in the craze of up to 2021. All right, they were still there, but they weren't necessarily making up a huge percentage of the market. And so when you look at these products, one of the things that is really important is the blue bars on the bottom. And that is, like we talked about on the left-hand side, that, okay, look, for these like cookie cutter loans on the left-hand side, you can sell those for a lot of money. On the right-hand side, right, these loans, you can't sell them for a lot of money. So when the companies go out to sell these at the window, it's kind of like the Wild West, and they're not just going and getting 350 to 400 basis points. A lot of times there's only 100 to 200 basis points max when you go to sell these products out on the right-hand side. And so that then creates this really large, this kind of core issue, right? And so I would say this slide is probably going to be one of the most important that we look at today, because I think it fundamentally shows the math behind what is the problem with regards to loan officers' opportunity to both win on rate, right? Because I think one of the biggest challenges that loan officers are having when it comes to winning loans right now is it is such a competitive pricing market, right? It's just, because there's so fewer opportunities, whether your client's getting blown up with trigger leads or whether or not they just have more like a loan officer, a cousin, a brother, whoever is getting thrown into the circle. It's very common that we are competing on a daily basis against multiple people to win loans. And unless you have the opportunity to win on rate, you can try and sell all the fluff, but most of the people that are still left in this business are really good at what they're doing. And it's going to come down to rate, because they can explain what the value is of a lower rate much easier than what the value is of more phone calls during the transaction. But on this slide, what you see is just, and these aren't my stats, right? You can see we sourced this from Housing Wire. This is the most recent data that we had in terms of the average production expense, right? So when you drop a loan into the IMB, into the large retail banking model, right, that has the layers of management, that has the underwriting, the servicing, all of that that machine, how much does that cost in basis points per loan, right? And so we put this on an average 500K loan amount to pull that down, but it's $11,000 per transaction, or 11,000 and change. It's almost 220 basis points, right? You add your comp on top of that, right? And you can see if you're making like 100, 115 to 120 basis points, or 100, whatever, that's probably where your rate sheet's going to be. So when you go out to compete for a loan, you're going to be selling your loan at, call it 320 basis points or 350 basis points. That's your rate sheet. When you come down to like Arbor, and whether it's Arbor, whether it's another broker, people that are in the independent space like us, we have outsourced a lot of the manufacturing process, right? So a lot of the manufacturing is being done. Everybody I think on this call has probably heard of United Wholesale Mortgage. They got football fields of underwriters, right? So they're going to take on that expense, their secondary marketing expense, all of that overhead. And what that does is that it reduces that out of our side of the fence, and it frankly, it takes it away from the rate. So on average, our cost per loan is 2,400. So it's 50 basis points. So what you're seeing there is that spread gap is about $9,000 in manufacturing expense. And where this is really important as it relates to winning loans and also just having loans to compete in the market is that if you're at a company where the average expense to manufacture the loan is 220 basis points, right? And like we talked about, like the loans that are trading now, they don't, HELOC and fixed rate second mortgages don't trade at a high margin. I don't know where you all are coming from in terms of at banks and whatnot, but there are HELOCs out there. We as loan officers at Arbor in our lane are selling HELOCs, and we're getting, they do pay 2 points back. They pay 200 basis points. What I tend to see at other places in IMBs, they might say, oh, you can do HELOCs, but you're going to pay $500. So then loan officers, they don't want to gravitate. They don't want to do it, even though that's one of the most valued type of loans right now in the market that consumers need, right? So that in itself is that if you were to say, I need to pivot to a place where I can convert HELOCs, if you were to go through your existing database, there is gold in there right now with clients that you have that want to do home renovations, that want to pay off credit card debt, that need a HELOC. But in all of these cases, right, the bottom line is that if the company, if it costs them $220 to make a loan, and then when they go to sell it, they can only get 200, right? They're not going to offer those products to you, or they're just not going to pay you what you should be getting paid. All right. So from a winning loan standpoint, right, I think what that means is, I think it's what I'm trying to communicate to y'all is that you should get smart on what your corporate margin is and what rate sheet that you're selling, right? Because at the end of the day, when it comes to winning loans, if you are going out there and you are out charged to go sell a 350 basis point rate sheet, and we're out to go sell a 200 basis point rate sheet, you're going to have to overcome 150 basis points, which is going to be somewhere between 1/2 to 5/8 in rate. And I'm sure everybody's a great salesperson, but at the end of the day, so are we. I don't know, and we can sell, we can do a lot of math for these folks and walk them through why that's going to be a better win for them. So that's, it's not mind blowing, but look, if you want to make sure you put yourself and align yourself with a company, educate yourself on what you're selling today in terms of an overall rate sheet against what your competitors are at. And then you need to align yourself in a place where you're not going to be going out to the fight with one arm tied behind your back when you're out there fighting for loans. And that fight is a lot more intense right now than it ever used to be, which is why I think this is, a more meaningful discussion than it used to be maybe 3 years ago. Okay, so let's take a look at kind of who's winning now, right? So if we look at the marketplace, and I know that it kind of gets divided, right? I mean, you have like the bankers and the brokers. There are people in between. Shameless plug for Arbor in that we are a hybrid, right? So we are a mortgage banker. We're also a mortgage broker, and we really design our business around trying to accommodate and do the best of both worlds. Because again, as an originator, I truly believe that you can't be on either side. I think that mortgage bankers there's great benefit from what IMBs have done, and what a lot of the things that make them great from their marketing and manufacturing processes and what they do, I think bring a ton of value. And I also think there's a ton of value on the broker side of the fence. And I think to win loans, as an originator, you have to have the best of both worlds, right? You don't want to you don't want to be pitted on one side of the fence, because as you can see, you're not going to have as many opportunities because you're only going to be good at one side of the fence versus the other. So that brings us into this referral loop. And I don't know if I don't know if everybody who's listening here are referral-based loan officers, consumer direct, but this is, you know, we're a referral-based company. So this is really geared towards referral-based LOs. And the idea here is, look, I mean, we try and keep this as simple as we can in terms of what it takes to actually to generate loans, to win loans, and then to, you know, create depth in your database to continue to win more loans beyond that from on the referral side of the house. So the referral loop is really what drives Arbor, probably what drives a lot of companies. But what it really comes down to is, look, we on the front end, we've got to, and I think this is also a really, you know, key benefit, even though everybody knows this, but look, it's a good reminder for everybody if you want to win loans. The function of how many loans you're going to get is completely based on the number of conversations that you're going to have, right? It is all about having conversations, right? And so the conversations are going to generate your opportunities, and those opportunities then are going to generate loans. And if you execute on those loans, they're going to generate more conversations. And I think where you find people being challenged today is, look, on the IMB side of the house, they've got great marketing, right? And they're going to help you generate conversations. We kind of already talked about that you might not have all the products. So when that conversation turns into an opportunity, do you have all of the products necessary to take advantage of what your conversation has generated, right? It generated a phone call that, hey, you know, Ryan, do you have this loan, or can you help me out? And when you go and can you say, oh yeah, I've got that. I can do a bank statement second, you know, and help you cash out our investment property, fixed rate second mortgage on bank statements. I can do these, like I have options to help you depending on what that call is. It's important to be able to take advantage of more of those calls, like we talked about on the previous slide. Then this one is kind of the big one, right? Because then ultimately I say, yeah, I can do that. Well, great. That consumer's like, awesome. What's the rate? Where are we at? And this is the part that becomes a big problem right now for a lot of folks that don't have competitive pricing, because they quote the rate. Then next thing you know, the consumer is going to go out and they're going to get another quote. And then if we end up losing that loan, then the referral loop is broken. And the point being is that if the referral loop is broken at the top on the product side, or the referral loop is broken at the rate quote side, then nothing is working, right? Because really, as we all know, if you've been doing this for a while, the true benefit of this comes from having a successful close, right? That we can then parlay on and really start marketing to our past clients and diving deep into our database. So let's dive into this broken side of the rate quote. And I just want to, rather than going through the slideshow, I want to really get into like, let's price a loan. Let's start pricing a couple loans, and let's start looking at how these parts of the wheel are built here at Arbor, and how we use them to kind of generate more conversations, more opportunities, and win more loans. And and hopefully you can, you know, copy, emulate, or do something that might help you pick up a loan or two. So I'm going to share my my other screen here so we can get start pricing. All right. I always need to, like, Jess, are we on Sifter? Right. Making sure.
Yep, you can see it.
Cool. All right. So and I would encourage everybody, this gets into like, we can use this as a way for you to really identify what rate sheet that you are on at your company. So here, I welcome you to price this out with your own company. I'll price this out today. So this is the details. We'll do two loans. We'll do a conventional, we'll do an FHA. So we do a conventional loan here. We're going to run, this is a purchase. This is like as cookie cutters as it gets. $800,000 purchase, 25% down, 780 FICO, single family owner occ, 1 unit. And then we're going to run this borrower paid, okay, so that we have no comp built in, so that you can see what the true pricing is, because that's going to give you the ability to back in to see where your corporate margin is. So when you price out this scenario today, and let's say it's like, oh, I'm at this price paying points, or I'm at I'm at this price at no points, you can kind of back in and say, oh, well, that's what rate sheet that you're on, like we were talking about earlier. So I'll walk you through that real quick. So here we are, we're at 6%. Now, again, mind you, this has no compensation. This has no LO comp. This has no corporate comp built in, okay? So when you look at this, we're going to say, all right, well, here's Providence leading the charge. So if I wanted to go out and say, Mr. Borrower, I can offer you 6% today, but I have to charge my LO comp and I also have to charge my corporate margin. So if you were going to do that at Arbor today, you'd say, Mr. Borrower, I can offer you 6% at 215 basis points. And this might be really easy for you guys to do, because you could sit there and go on your pricing engine where you are today, and you could say, all right, where are you at 6%, right? Are you at 300 basis points, 350 basis points? Because that, then you could compare that with 215, and that's going to give you the spread difference on that rate sheet at least at 6%. Okay. You come down here and it's like, we're going to be running anywhere between a 200 to 215 rate sheet. So 6.625 to 6.75 is where we're running basically a no point loan. So the loan officer is going to retain 150 basis points of this, and the corporate margin is going to get sucked out off of these lines. And this, again, is where if you're pricing this out today, you might want to say, okay, where are you at 6.625? Okay. We're at 200 basis points. So if you're at 6.625 charging 1 point, then you're at 300 basis points. Okay. But I think it's, and then, one of the things too, is you can see here, and this is where you can see kind of the breadth and the difference of all of the different options. And you can really see how tight the pricing is over here. So this is where you have kind of the freedom of choice to decide, okay, well, maybe I'll go to, if I want to sell this 5.99 over this, and I know this is just a $500 cost. So I'm going to go to UWM and I'm going to sell 5.99, right? So that might be where you get to drive it. But again, this is where you have the flexibility to really move in and drive the loans where you want. And you can see here, like 6.625 is that's paying 1.7, which is a little more than where we were up here. So we're probably going to, if we wanted to sell that rate, we're going to go up here. All right, so let's take a look at an FHA scenario here. So on FHA, let's price that guy out. So on an FHA deal, right, we're going to be looking at 5.625 is with all of the margin priced out. Okay. And then when you come in here, you can start to see, okay, like 6.25 is where we're going to be really close to offering a no point loan on an FHA transaction. So we'd be looking at 6.25, charging a little under, like less than an eighth. Okay. On that deal. And again, this is useful for you, hopefully, because again, it's a window in. And I think the concept of, again, to tie into the theme of winning loans, I think it's really important for loan officers to know what you're competing against out in the market and out in the street. So rather than going out to the fight blind to go win something, right, I think it's important to know where you need to be. And unfortunately, most of the time what's happening is like, you're going to go out and you're going to price what you need to do, or you're going to have to like take some, like you're already going out with a concession, and then you're going to have to cut into your comp, or you're going to have to run the loan under somebody's name to do it cheap, all to be able to kind of compete with where this is at on a daily basis. All right. Okay. So that's kind of, that's how we, that's where we are at in terms of, solving the rate challenge for folks. But look, rate is not everything. And I think one of the most important things, and again, are another key in terms of what it takes to win loans, on a daily basis. And actually what it takes to win loans from a career standpoint in the mortgage business is you really need to be able to have a digital marketing strategy, especially today, right? Digital marketing and digital marketing strategies are what give you the ability to do more with less. Those are the things that say, okay, look, how I need to have more conversations. How many conversations can my digital marketing process help generate for me without my manual input, right? So how well can it go through my database, and how well can it identify opportunities for me to have more conversations? How many redundant conversations can it take off of my plate, right? So like, I'm not constantly having status update calls. I'm not having, call them, I like to separate conversations into two buckets, right? There's revenue generating conversations and there's non-revenue generating conversations. And if you want to identify on a daily basis how well you're doing to grow your business and to win loans, you can just sit there and ask yourself, how many revenue generating conversations are you having versus non-revenue generating? And if you're not having those, and frankly, if you're not doing enough loans, you can just sit there and go like, I just need to have more revenue generating conversations. Those are the things that really drive us here at Arbor, right? And so this concept of a digital marketing strategy, I guess the easiest place for me to start is in like our marketing automation library. So this is where you can see that there's over 92 pages of where these are digital marketing conversations that we've already built out for our loan officers, that you can either tag somebody to go out for you, or they're just happening automatically. So on every single refinance, every single purchase, all the communication is going out to your borrower, co-borrower, your realtor, your listing agent, your selling agents. On every post-close, on every transaction you close, right, you're going to have all of your communications going out to your borrowers and your co-borrowers. If you have opportunities for refinances, we've already got those are built. You can basically just click on a button and your database will have an automated sequence that we've written via text and email to go out and help convert those redundant conversations to identify opportunities that are out there. And if you're not doing that, again, that's what we're doing, right? So if you don't have a digital marketing strategy that ties into your current production goals and what you're trying to do this year, I would urge you that is something that you need to do that will help you win loans in 2024. It's about how am I taking advantage of digital marketing to generate more conversations. Great example of this is you can look down here is our pre-approved nurture automation, right? So I know that we're still in a heavily intensive purchase market, but it's tight inventory, right? And I like right now I have, I think 8 or 9 pre-approvals that are out there looking for homes that can't find homes. And we were having an issue because, that lead and that dialogue, everybody's really excited when they call you for that initial pre-approval, but then they kind of fall off downstream because, they get frustrated or they're not getting the house. So we built a nurture automation that is sending out this sequencing of emails and texting that's kind of keeping them engaged, saying, hey, we're here for you. Like, take a look at, basically kind of giving them good intel and just thoughtful data around the housing market, wealth creation through buying homes to keep them motivated to buy. But again, these are things that we automate for you, right? And so I would look at your business and say, what can we automate from a digital marketing standpoint to help you generate more clients? The other thing I would just tell you real quick that will help you win more loans and frankly, just find more loans is asking yourself, like, how deep are you capable of going in your database? I think most loan officers today are really focused on the width of their database. So they're like, hey, I'm going to focus on going out, and everybody's like, I got to go get realtors, right? But my feeling is there's so many contacts and there's so many conversations that exist in your database today. Like, for example, I'll just pull up like a new client of mine. But when I go into my database and I go into like my client, which is Jeffrey Lindauer, new person, right? This is a new purchase. This is a pre-approval. Now, I haven't done this yet, but I can tell you right now, I know who referred me this contact. I know who the realtor is. But the concept of depth right here is, okay, am I conversing with them on social? Have I done these things? These are things that we need to do to start building depth in the database that will help us get referred and win loans. The other thing is, if I can gain depth in from, okay, who's their attorney, who's their CPA, who's their financial advisor, all of these folks that are potential referral sources for me, how can you keep track of the depth that you're getting through in your database? And I think that depth right now, in the previous markets, I think width was really important. I think that depth is something right now that you need to key into, and we have tools to help you achieve that. Just to give you a quick example of that, right? Here's one of our loan officers. Here's his website, and kind of as he goes in here to kind of focus on, look, let's dive in specifically into specific type of transactions. that will resonate. Like, so a bank statement loan specialist is somebody that is going to resonate with a CPA. So as you grow depth in your CPA side, you can hit on these type of videos and this type of social media strategy to go through here and explain bank statement loans and convert CPAs with this type of digital marketing. So that's something I think that's really important. Okay. So I know